story in markets yesterday, oil. It's going to be the big story today as well. Take a look at what's going on this morning. Down 2 1/3% on crude. $1.14 lower, below $50 a barrel for the first time since December. Crude oil prices tumbling to the lowest level of the year yesterday. The biggest one-day decline since February 2016. Joining us right now, the founder of the Schork Report and oil analyst, Stephen Schork. Always a pleasure, Stephen. Thanks for joining us.
Great to be here. Thank you.
So what happened yesterday, and what are the concerns about oil? Do you think longer-term oil prices go down?
Absolutely. I certainly have been on the bearish side of the ledger, Maria, for the better part of, well, since basically the OPEC announcement back in November. And that said, so what did we learn yesterday? What we learned yesterday is what we've been learning for the last 3 months. Regardless of the rhetoric coming out of OPEC, we're still producing and we still have a lot of oil in this market. And in fact, U.S. producers are now putting 500,000 barrels a day more oil onto the market today than they were prior to the OPEC announcement. So let's put U.S. production, or excuse me, U.S. supplies into perspective. Yesterday, supplies rose to a modern-day record of 528 million barrels. That said, our friends on Wall Street, the bulls, own so much oil, they could cover 80% of that record length. That's how much oil they own in the futures market. And keep in mind, the futures is a derivative. It derives its value off of the underlying contract. And when we look at the underlying market in Cushing, Oklahoma, where you make and take delivery on these contracts, Wall Street owns 7 times as much oil in the paper market as it is in the actual physical underlying market. So the bottom line here, Maria, is Wall Street is long, and apparently they are wrong. And they are really wrong, and this is a concern, because what we've been saying in the daily report of the Schork Group for the past month is when we look at the amount of length Wall Street is sitting on, and then we juxtapose that with the amount of risk, that is to say the volatility in the market, we estimate that Wall Street is taking an $11.50 bet for every $1 the bearish speculator is taking. That's near an all-time high. So what we're seeing now over the last 2 days right now is a mass liquidation, I believe, of Wall Street bailing on their bullish positions. Right?
Well, and Stephen, I think you're highlighting a good point that you need to separate Wall Street from a lot of the E&P companies, because a lot of these shale producers can produce at $30 a barrel. They've wrung out tons of efficiencies, so it only costs them that much. And guess what they can do with the oil? They can ship it overseas. We can now export oil. So the American shale revolution is a good thing for not only the E&P companies, but for jobs, and they can continue to do this. So now, do you think that oil can, because the supply-demand imbalance you were talking about, stay at the 50 level, or will there be significant pressure to bring it down to 45, even 40, given what you were talking about?
I think it's an excellent point, and I absolutely agree, and hence that is one of the underlyings of my bearish thesis, is that regardless of what OPEC says they want to do, they're ignoring what North America is doing. And what people did not understand over the past 3 years is OPEC was not trying to destroy North American production. They weren't trying to destroy it because they couldn't destroy it. And in fact, OPEC has made this industry that much stronger. We're that much more productive. We're that much more efficient. And to go back to the CFTC, while Wall Street is very long the market, guess who's very short the market? Producers. Producers have sold an incredible amount of gas forward in the market. A producer only sells forward what? To bring on more production. So the producer is telling us via their CFTC position they're ready, willing, and able. And 6 months ago, the Dallas Federal Reserve put out a study to 149 executives in our industry. What price do you need to see to bring oil production back to a healthy level? The majority of the responses were, guess what? $55 to $60 a barrel, exactly where we were. So to answer your question, yes, I am still short-term bearish. My thesis for the past 3 years has been oil prices in the U.S. between 50 and 60 on the high end, 45 to 40 on the low end. I do think we are now past the midpoint. We're heading down to the low end. But keep in mind, we're in March. What happens in March? Demand for crude oil right now is at its weakest because oil refineries are in their maintenance seasons. But beginning over the last couple of weeks and will continue, there will be an upward bias. Demand will continue to rise between now and peak sometime in late July, early August. So if we are going to see a bottom, and if oil is going to rise, it will have to rise between now and as demand picks up. But overall, I think oil prices are very comfortably priced right now.
All right, we'll be watching the story. Stephen, good to see you. Thanks so much.
Great to be here. Thank you.
Stephen Schork joining us.